Next, we're looking at another thing that stands to benefit from the spring statement, but I didn't realise this because I was set to talk about it last week before the spring statement, but it was set to benefit from other things in the UK budget. And the company is Cohort. It's a small UK company, trades on the AIM, has a 556 million market cap, and I would count this as a growth stock, Steve. It operates in the defence sector. And as we know, defence can be kind of more up and down than straight up, as it were, where it depends a bit on what's going on geopolitically. And they don't have huge amounts of say over that. In fact, they have nearly none. But, okay, so it's a more than cyclical, let's say, growth stock, but we'll call it a growth stock, which means that we start, of course, with the balance sheet. And on the 556 million market cap, this thing has 14 million in net cash available. There you are. You should buy it for that reason. Another reason you might consider buying it is that in the last 12 months, the thing is up about 106%, which is, a lot. And actually, it's tough to go buying things that are up 106% in the last 12 months. It's really tough to go buying UK things that are up 106% in the last 12 months, because that nearly never happens. And it's really, really tough to buy things that are up 106% in the last 12 months that have been largely chopping sideways since the beginning of time before that. But we don't pay attention to stock moves particularly. We look a bit more closely at the underlying business. So let's talk about the underlying business here. Watch the business, not the stock. Here's what the business does. It's a defense conglomerate. It's pretty much the only type of thing that's up that much, and that's to say it's a whole bunch of smaller defense businesses. They are largely tech focused. There's about 7 of them now, and they look to keep being acquisitive with that size of market cap. They have a few advantages. The kind of companies they look to acquire in sort of private, from being private, are typically, it's not huge amounts of competition for them. They can generally get reasonably attractive multiples, and they're good at when they do acquire them. So they acquired a company called Chess Dynamics, which is a surveillance and fire control outfit. In 2018, they've taken their margins from 2% up to 10%, which means that doesn't sound like an awful lot when you talk about margins expanding like this. But if your margins go up from 2% to 10%, they go up by 5 times, which means that the amount of your revenue that comes down into your bottom line is 5 times higher. So profits at Chess Dynamics have gone up an awful lot since they acquired it at a not massive EBIT multiple. Their most recent acquisition is a company called EM, which is a satellite terminals for sea vessels, basically, communications business. The obvious question, I guess, comes from why now? I mean, it would have been nice if one reason is because I hadn't heard of this a year ago, and I have now, so I couldn't have bought the thing back then. It trades at a PE ratio of 25, which is not insane. I mean, it's high for the UK. The US would think this is probably about right. Growthy things that are decentralized conglomerates do tend to trade at higher multiples than this. If you look at in the FTSE 100, there's things like Halma and Diploma and Compass and other things that this kind of model generally attracts a big multiple. It's higher than 25, but it's a reasonably true 25 rather than an adjusted 25, I think, in these cases. Why now? Well, defense spending is going up. So what we've seen across the Atlantic is the US has been largely trying to press NATO people into actually making their defense payments that they're supposed to be making. The NATO's participants are supposed to be committed to spending 2% of their GDP on defence, and nearly none of them have been doing that. They've been largely relying on the US, and Trump, make of him what you will, but one of the things he's succeeded in doing is getting other countries to start their defence spending going higher. Now, the UK does, and has, even before the spring statement today, met that 2% commitment and then some. It had been at 2.33, but the notes I've got here, which I wrote before today, had this set to rise to 2.5% and then 3%. They're now actually, rather than boosting to 2.9 billion next year, they're looking for another 2.2, and I noticed that Cohort is up about 2.5% on that news. And I think it might be an interesting way if you think UK defence spending is going the right direction. 25 times earnings, this might not be entirely crazy here. So that kind of means a 2.2 billion push and then 30% higher if you think we're going from 2.33% to 3%. So There's a few ways in the UK that you might look at trying to invest in defence, but I don't know that many of them are as neat as Cohort here. So if you look at someone like Rolls Royce, that has a defence arm, pretty big defence business, and a name you might well think of. But defence is only 24% of their entire operation here. So the overall effect I don't think is likely to be as high. And the UK is only 14% of their revenues, and that's across all three divisions. So look, even if you push something there up by a third, that'd be nice. You'd take that for Rolls Royce and happily, and they've got plenty of other things they're doing very, very well. Lots of other reasons to consider that stock, but higher defence spending probably isn't the most obvious one. The more obvious candidate is BAE Systems, but BAE Systems gets most of its sales from elsewhere. The UK is only 25% of that one, so a 30%, yeah, that would make a nice push. Cohort's 54% UK, so if they can just hold their market share in terms of UK government spending, you're looking at kind of 16, probably nearer 19 now percent growth in sales, and that will give them opportunities to do things like keep acquiring here. So I think this looks. I think this looks interesting, Steve. I'm not sure I can get it to the top of my buy list here, but it's a stock I'm glad to know about. I think they are a combination. Their acquisitions have been good, and they have generally moved things forward and higher. They've been boosted recently by quite a strong tailwind. And if you think, look, how much worse can global uncertainty get, or basically war in this case, I would have a lot of sympathy with that kind of line of thinking. But I'm not particularly just looking for that. I'm looking for longer term increases in defence spending. That's where sales are going to come from, where growth is going to come from. And I think it could plausibly be there. And if you start adding on top of that some inorganic stuff as well, as they about $500 million worth of company, there's still plenty of scope to acquire there at reasonable multiples. There's a lot of companies at 25 times earnings that would be below this on my list of stocks to buy. There are other companies that are not at 25 times earnings that are higher on it, but it's the kind of company that I think wouldn't be the worst idea to pay up for here, Steve.
Yeah, I can see that, Steve. So 33% growth last year, 11% growth this year is impressive on the top line. But really, their four key offerings are Ancilla. And now, again, just to caveat, I don't know anything about defence. I know nothing. So if I say something silly here and you do know about defence, I apologise. But Ancilla, it's a decoy launcher system, and it's just been taken on by the Royal Navy's surface fleet against modern missile threats. It's actually the group's largest ever single contract win. They think it's a really strong endorsement of Ancilla from an internationally respected customer. So you'd have to agree with that, the Royal Navy taking on a piece of technology. And that's what this company is. It's defence technology more than defence itself. So Chess's sort of key product looks to be ground-based air defence systems, but they've specialised into being efficient against drones. And obviously this has seen quite strong demand in 2024, mainly because Russia has resorted to huge drone attacks, and this system looks to be one of the ways to counter it. And they give some information in here that it's basically it says they're an existing class leader supplier of electro-optical fire control and targeting systems, meaning they were well placed to develop a wide range of solutions to address the expanding scope of GBAD requirements. The well-established Sea Eagle naval tracking system was adapted to meet the requirements of mobile land platforms. So basically, it's a system that goes onto a land gun, by the looks of it, which is used to take out essentially drones. But also there's a sea system, anti-submarine warfare system, and ELAC sonar. So they've secured an order to provide its Sphere sonar technology to a third Italian Navy submarine. And again, that's another sort of customer endorsement of this technology. So look, they've got some really interesting sort of irons in the fire here, Steve. I think it's, again, until you told me you was covering it last week, I knew absolutely nothing about it. And I'll tell you, I know 1% about it now. But the things that they have are interesting. But my worry is to go from 33% growth to 11% growth. What's going to happen next year? They think that they could continue to grow in that kind of area. Their order book, they think, will be 10 to 11%. And could be mid-teens in the 3 to 5 year range. That might be interesting. But do you want to pay 25 times earnings for that, Steve? It's pretty tough in the UK market because that's trading at quite a premium for that kind of level of growth. Obviously, if they can sustain it long term, you're laughing. But yeah, it's a small company at the moment, and it's easy to grow small numbers. The law of large numbers kicks in at some point, and we'd have to see where we go from there, Steve.
Yeah, it's interesting. I sort of feel like I don't often call things holds. I tend to think I'd either buy them or sell them if I owned them. And Cohort, I sort of feel like if I'd bought this thing a year ago, when it was much more attractive than it is now, I wouldn't be selling it. As it is, I'm probably not buying it. I wonder whether I wouldn't be selling it just so I could feel pleased with myself about how it had gone. I mean, yeah, so over the long term, I think there's a good amount that kind of is going to have to rely on a combination of growth factors. One is acquisitions, and the other is higher defense budgets. Higher defense budgets are possible, but I wonder whether increases in spending are going to prove to be cyclical as well, and that's, I guess, the risk at the time. At the moment, you have a US administration that is leaning on everybody else very hard, and I'm not saying the UK has been necessarily bothered into this, but if you think defence spending's on the rise, this is where I'd look. Will it stick around? Don't know, but it'll be interesting to see and keep an eye on. I have a feeling I'm going to watch this keep going higher and be cross that I didn't buy it, to be honest. Stephen, it will get to the point where I think this reaches something like 3 billion, and I think that's ridiculous. I saw this when it was half of one, but I will just sit and watch. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.